Your biggest risk isn't the deal, it's losing investors' trust. In this conversation, a $10 billion CEO breaks down how overcommunication, disciplined no-go rules, and tested syndications protected LP capital and unlocked scalable raises. All this and more coming right now. Here we go. Jason, welcome to the show, man.
Thanks a lot, Ryan. I mean, from the first time we chatted, I think we hit it off great, and we're on the same wavelength when it comes to everything business and even personally. So I think this is going to be a lot of fun, and I look forward to being on your show. Thank you.
Yeah, it's great to have you, man. We've been fortunate enough to be, in the top 2% in the world, all because of amazing guests like you. So let's jump right into it, man. You've built a massive investment firm. I think you're around 10 billion, keep me honest. Mm-hmm. So 10 billion under management in Canada. I was telling my wife that's probably the equivalent of 100 billion in America. So that is quite an accomplishment to pull that off. As I like to call us, we're the chosen frozen. So good for you, man. You've pulled this off. So I'd love to jump right into it, man. So you've built Skyline from early student rentals into multi-billion-dollar real assets. What are the 2 or 3 inflection point decisions that changed the slope in the curve, and why do you think that happened?
Well, we started just a mere 35 years ago in Guelph with our first student rental, $123,000 student rental, semi-detached in Guelph here while going to university with the help of our dad. We started to have an appetite for that with a friend helped us buy another one, and then we went up the street and then we got our real estate licenses and then we started buying for ourselves and growing. So stage one of our business was getting up to these 52 student rentals across Guelph, but that's not sustainable. That wasn't going to feed our appetite if we were going to, grow to where we wanted to be. So we, that kind of could be the first inflection point where we learned about scale and we learned about leverage and we learned that, one 52 unit apartment building has only one roof. It has only one lawn to cut. It has only one furnace that usually doesn't spark up first cold snap in fall. But, we don't have this headache that happens with all these rentals spread out across town. So we started buying apartment buildings. We could get scale. We could get leverage. We could get on-site staff. We could do that stuff. It did require bigger down payments. So we started then reaching out to families and friends at the time because they were the only ones that would have the trust in us that we were going to follow through with it and manage their asset well. So we did that, and we then grew and then started syndicating. So we were getting leverage from investors and the size of the assets that we had. But by doing syndicates, we had a structure that was now one corporation, 2 corporations. Now we had 16 corporations. We now were running into efficiencies at that level. So come along kind of inflection point number 2 in the business was then to amalgamate that up. We had acquired, we had about $27 million of investor equity, $83 million worth of assets across these 16 corporations. We balled those up, and that was the lily pad to launch our REIT in 2006. So since then, the Skyline Apartment REIT has grown from that 83 million to 5.2 billion of assets across from coast to coast in Canada, primarily in secondary, tertiary markets, which is what has been our strategy, which we can talk about a little bit later. But so then that evolution became efficient. These open-ended funds that then it evolved into a retail fund as well, and then an industrial fund, and then a clean energy fund. That growth, we hired them off and had these products that when we had them all in one fund, and the choice wasn't in the hands of the investors. If we made the funds then more streamlined and more dedicated to an asset class, that's when the choice now goes into the hands of the investor, and they get to pick where they put their money. So that's where we are today. These open-ended funds, they can grow and grow and grow as long as we can find good assets to put in them, and we're going to continue to do that. And kind of inflection point number 3, we're in the middle of that literally as we speak with our investors who've been with us for a long time. Some of them have put money in, has turned into substantial wealth that are coming back to us now and saying, hey, look, like I've got this money, I've got this Skyline, and I've been with you for 25 years. I want to think about how to transfer that to my next generation. I want to think about estate planning. I want to think about all that stuff. So we're now shifting from not only being asset managers of their investments, we're now looking at being investment managers for their life. My partners and I, we're all at that stage of our lives where we're needing that ourselves. So it a lot of these things were born out of necessity as we evolved, and we listened to the market and we listened to our investors, and here we are today. And what's going to happen in the future is going to be led by the market, and we're going to respond to it.
Brilliant. So the 3 inflection points, just to make sure that I got it. Number 1 was moving from, say, single family homes into multifamily. That was number 1 that changed the trajectory to go from million AUM to billions. The second one was you rolled out a REIT. And I think the first time we met, you said you're you're north of like around 5 or 6 billion already under that.
Yeah.
And then the third one is you came in an EMD, an exempt market dealer. For my American friends, that's close to an RIA, but quite similar. And you would say, those three areas were probably the most significant impact in accelerating your curve to go from, an emerging fund to someone more on the institutional scale. Is that right?
Yep. Yeah. We just went along, and then that change to the buildings was increased the curve, and then going to the open-ended funds structure, the REIT structure, accelerated that curve, and now taking that equity under management that is $4.5 billion according to our KYCs of our know your client profiles of our investors, they're worth $24 billion. So for us to hockey stick again will be to manage the rest of their assets that they have and help them do that, not only just in our Skyline products that we built, but then in creating liquidity through other vehicles and other ways. So we're just going to continue to increase that trajectory as we go along in life.
That is brilliant. So it's so good to have that look back, which probably took you decades to do, and we got it in minutes. So thank you for compressing decades into minutes.
No problem.
That makes me wonder then, what is Skyline's core investment thesis today? And what was the first cycle stress test that proved that thesis?
Well, I mean, our investment thesis was to buy assets, efficient assets that we could manage and get leverage from and get scale from. We were more small town guys. We grew up in Walkerton, Ontario, which is just north of Guelph, where our home office is here in Guelph, and so we knew a lot of the small towns. We played hockey in a lot of these small towns, friends and family from these small towns. So we kind of adopted early on. It was pretty easy. When everybody got a newspaper, we said, do you want to know what we do? Open the paper to the sports section and look for Junior B, Junior A hockey teams, and that's where we're going to own our real estate. At the time, the apartment building in that town was the apartment building. That was the one to own, but it wasn't institutionally owned at that time, and we could often buy those assets at lower multiples of earnings for the income that they spun off, as opposed to more urban areas like Toronto and like Edmonton and Vancouver and Calgary and Montreal. So we liked that we wanted the value there. We just couldn't understand why I would pay 25 times earnings for something that we could pay 18 times earnings in the town. And we felt that income in those secondary, tertiary markets is more durable, more reliable, more consistent. It was just not as red ocean competitive as it was in the big urban centers. So that's been a thesis that we've always stuck with, and it's served us well. Now, as the market has expanded and become institutionalized, I think it's also helped us because there's been more of a homogeneous drift to a more consistent cap rate. So things that we were buying at higher cap rates in those markets are now getting compressed to be more in line with what's in the urban areas. Take our retail fund, for example. Why would a Shoppers Drug Mart in Toronto that's a 4 cap be valued at 25 times earnings when a Shoppers Drug Mart in Listowel, Ontario is valued at 18 times earnings? It's the same corporate covenant, and arguably, it dominates the market more in Listowel than it does in Toronto. So that we were able to buy and accumulate those pharmacy, grocery anchored assets. And now as things homogenize in cap rates, we're seeing the lift, as opposed to Toronto coming off a 4 cap. They're obviously going to be very expensive in those areas. We're going to get our cap rate compression, and that's going to add value to our fund.
Brilliant, man. So really those secondary and tertiary markets is like avoiding the red oceans, I think, was another element that you talked about. And you said, we thought this through in the early days, and still now we go for secondary and tertiary as much as we can. That is where our thesis is. That's what got us to where we're at. How am I doing so far?
And that's pretty simple stuff. We just believe in these markets, and we believe in the cultural and fabric of Canada is made up of these communities, and so we have proven that we can be just as successful in those markets as I think you can be in the larger urban centers.
That's brilliant, man. So when you say that you hire expertise and drop ego, what's your repeatable process to identify A players, and what are you doing to keep them performing at scale? Because I know this is a problem for a lot of fund managers, asset managers, wherever you are, business owners, hiring A players and keeping them all performing at scale. What are some of the things that you find that have been quite helpful for Skyline?
Well, we built our company as entrepreneurs, and you like to think that you know what you're doing and you've got it going on. But where I think I was wrong early on was to think that somebody I would hire to do a specific part of the company or run a certain part of the company, they might do it 80% as well as I would. But if I could get 5 or 6 people at 80% efficiency. I could get 400% efficiency of what I would do on my own, doing everything that way. I was dead wrong. When you hire specialists to do that, you don't get 80% efficiency. You get 150% efficiency. I'm the jack of all trades, masters of none. They're the experts in those fields, and they can accelerate and they can help be better at those aspects of the business. So getting good talent and giving them the limits to go and express themselves and be an influence on the culture and the value that's brought to the company has been something that I think we've been a success at doing. Like, as we continue to grow, people say, like, when's enough? Or, what size you want to be at, or where do you want to go to? And, we owe it to our staff now and to our teams to continue to grow, because they come to Skyline with a motivation and a drive and a desire to spread their wings and apply their expertise. So if we're not growing, why would they stay? Why would they want to be a part of this? So, we owe it to them to create opportunities for them to grow and as human beings and as individuals and as business leaders. And again, I think it's something that, we've seen a lot of people come in at very junior levels that have very big jobs today at Skyline and very important roles. So it seems to be working, and we're going to continue to grow that way.
The first time you and I met, we became fast friends, as we talked about earlier in the show. This subject came up and you said, what I've learned, Ryan, is high performers want autonomy and growth. And I'm thinking back to my corporate days, and, you're like, I could do this in 10 minutes. And, you want this autonomy and growth. And I thought, man, this guy has his company dialed in. Like, to be a fly on the wall would be such a treat, brother. That would be phenomenal. But finding these A players and then trusting them, shocker, that actually works. So A players don't need babysitters. They just need you to get out of the way, and they'll report back. Just tell them when you want to hear from them. They'll get it done. And I know, as being one myself, is just saying, like, honestly, if you just clear the runway, I promise you I will launch like an F-16 off an aircraft carrier, man. Like, just clear the runway and I will take this thing to the moon. And a lot of high performers want that. And typically, and I'd love to get your opinion on this, for me, it always comes down to the why of the company, the heart of the company, and really just digging into a vision and a process and a mission that I believe in. Hey, if I feel like I'm doing the world good, watch out, man. I'm going to fire up the afterburners. Have you found that having that compelling mission and drive is really what unlocks these A players and gets them to perform at scale?
Yeah, for sure. And it's funny because, people want to perform and they want to do well, and they like doing deals. They like operations, or they like different parts of the business where they like to excel. But, I think one really good reaffirming part of our business is that we stand shoulder to shoulder with our investors. We have social functions and we do things like that with our investors. And some investors are really operations oriented. Some really like high finance. That some of them like to hear your acquisitions, and all different parts of the business. We make our teams are all available. And when those people can come and talk directly to the leaders of our company and say to them, hey, I retired early and I travel on my Skyline, or my distributions from Skyline, or I have this new hobby, or I put my kid through university, or all the areas. That altruistic value that brings there is hugely motivational and makes you want to go back and work with the people who you've looked them in the eye. That's where your money comes. It's not nameless, faceless investments. These are real people that you've changed lives, and going out and doing what you do. It sounds kind of corny to say it, but it really matters. It really changes, and it's of course you have to be responsible with the numbers and the deliveries, but that story just gets you across the line and gives you that extra oomph that makes you hit the ground running in the morning and wanting to perform. So, and that's what I believe drives our people. That's right. And I can tell you're very passionate about taking care of your people. So I can see why you were nominated. Your company was nominated as one of the best places to work at. So this is great. Now, one thing based on my research, Skyline runs multiple funds and REITs. You got a lot going on. So how do you guys decide when to create a new vehicle versus just evolve an existing one? Well, I mean, our funds, once they've started and we've made a commitment to that fund, usually, again, if you go back to our early days, it was residential. So we evolved that residential was our first fund. And as we were buying some of our early assets, at least in the apartment fund, sometimes, we'd go to a vendor and we really like their apartment building, and they say, hey, well, you take my apartment building, but you got to take my retail plaza. So it's like take all or get none. And so we would take all, and it goes in the fund. And all of a sudden we had to learn how to operate retail, and we had to learn how to run that industrial building and that. So the evolution was then, to take that and then create those funds out of that. So there was an evolutionary process and a market force that kind of drove us into doing those asset classes and separating them that way. We like to say that we test drove them ourselves and tested it out. And what do they say? Every 10 years, School of Hard Knocks is like the equivalent of a degree, a university degree. So I should have about 3.5 degrees right now, and in doing this. But we're driving, we're finding opportunities, and then we're testing it out on a lower level, on a syndicate level, and then we're building that out into a fund. So it's evolving, but it's accelerating as well. There's lots of asset classes that we can apply the same protocols to, the same systems, the same management styles and technique to in other classes. My partners and I have a few hotels together that we've acquired with some additional shareholders as well. And could that be a product one day? Quite likely it will be. So, but we have to learn it. We have to learn it on our dime, and then before we'll take it and test it to take it to the market where we can't afford to make those mistakes.
I want to highlight this to the listeners that one of the cool things that you do, and I haven't heard very many, if any, fund managers do this. So I really want you to zero in on what Jason was talking about. He tests the thesis in syndications before rolling it, before going big time. Did I hear that right?
Yep. Yeah.
So testing that's startup 101, man, is test. Is there a market for this? Are there investors for this? Are there deals for this? Can we make the numbers work? Let's get all the testing and then go and scale it. And I talk about this all the time, especially about everybody wants to start with a fund, a $5 million fund. And I was like, you're going to go bankrupt. Yep. I was like, do syndications, man. They're great. It's a great way to test your thesis. So it's something that I absolutely love about you. And I can't underscore the importance because not a lot of people do this. So you figure a guy who's managing 10 billion, when he says he does something a certain way, probably a good idea to really look into it and do it yourself, which is it's okay to test your thesis on simple syndications before you roll it into something big. Would you agree?
Yeah. And like we go into these with these limited partnerships and how we test it out with, we choose our partners and our limited partners carefully and we make it a collaborative process. Like, what are you looking for? What do you want? Like as part of this, like we take feedback. A lot of our investors are very successful entrepreneurs in their own right. And I've received a lot of advice over the years from those investors. And so it helps shore up your plan and have you thought about this? Have you done this? And what does this mean? Like we get a lot of really valuable feedback from that. And it's a lot easier to kind of stumble and fumble into a new asset class at a smaller level than blow your brains out by going big. Like you don't want to do that. You want to. I hate it when I say I start to sound like my dad. You want to crawl before you walk and walk before you run. When we were younger, we wanted to sprint right away. So, but with time and experience and something behind you that you can't afford to risk or a reputation you can't afford to ruin, you have to go through that process. And people just sometimes don't want to take that long route. The shortcut, is sexier and looks more attractive. But I'll tell you that doing it the right way matters, and it gets trust. And it gives you reputable, a good reputation that people will get behind.
Brilliant. You said the magic word. So I always believe that reputation, relationships, and results are the best, most valuable assets in any fund manager's position. And, that's part of it. And those are all sustained by what I call the fourth R, which is rituals. Like, how do you conduct yourself, your own conduct?
Right.
So we got reputation, relationships, and results. You build those, value or destroy them through the habitual practices. But there's also something else that you and I spoke about the first time we met. And I geeked out hard on my investment philosophy, especially in funds, where I said, high finance is more about trust than transactions. And I feel like a deal is just a way to monetize the trust that you've earned, rightfully so, through your reputation, relationships, and results. There's a little bit of a logic chain here. And so my question for you, and especially Skyline, because you guys are so good at what you do, how do you guys operationalize investor trust as a system, like either through communication, transparency, just so it compounds and reduces the friction in future raises?
Well, I mean, early days, we had no track record. I would say we had a big hat and no cattle, and we were, you fake it till you make it. You do this, and we had a thesis, we had an idea around this, and when we were putting our investor equity to work. Now, early on, we're investors who knew our character and known us for a long time, and if this was going to bumble or it wasn't going to go just as smoothly as it was, they knew we were going to stick to it and see it through. So but as you do that more and more, and you have time behind you, and then you start to produce results that back you up, then now you can broaden who you're going to and who your investors are. But those early days, communication, like so many people get it wrong. Like when things go bad, they just clam up and they go silent, and that's the worst thing you do, because an investor will go to the worst place. They'll think of the worst thing in what's going on behind the scenes. Talk it through. Communicate. You should up your communication. We've made that a philosophy. Like through most recently COVID, we were on Wayne, our CFO, was going on regularly giving updates as to what was going on and what the funding and the grants and how we were doing with our rent collections and all that kind of stuff to calm our investor base down and keep them highly knowledgeable about what's going on, so that whatever the media was saying isn't a broad brush that paints all of us the same way. If so we were we really believed in communicating with our investors and engaging with them, and being honest with them when things aren't going great. You got to tell them that too, and they'll accept that. They read the news, they know what's going on in the world. So some of those things you can do as much as you can operationally to get everything tight. But when there's a macro something political or whatever it may be in the marketplace, it affects everybody. So as long as you're operating it and doing what's right and communicating that to your investors, that's gonna help quell the uprising in the storm. And we've been through we were syndicating when the .com bubble was going on, and we weren't sexy enough for some because that was going on. We were there for the 2008 crisis. We've seen multiple stock market corrections. We've seen wars, COVID, you name it. We've gone through that all, and each time we learned from it. We communicated through it, and I think it prepared us for the next thing that's about to come, because there's always something, right? So,
hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
I think that's been the secret sauce for us is over communication. It's a lot easier for an investor to say, okay, whoa, guys, or I don't need to watch that next little video you put out, as opposed to saying what's going on and then speculating wrong.
That's right. Yeah. You reminded me, a good friend of mine was on the show a while ago. We just caught up. You might know him, Michael Episcope at Origin out of Chicago. And, really good thing. And he understood. It's funny. And you cross the billion, you all talk about the importance of investor relations. This is something that I think gets glossed over at emerging fund managers' peril. And one of the things that stuck with me, and it sounds like you do the same thing, is we walk out good news, we run out bad news. Mm-hmm. And, I was telling my wife too, just in general, talking about investor relations. I know I'm a blast at cocktail parties, but they getting people on board, they don't care if it's good or bad, generally speaking. What they do care about is if you're not forward straight, or you sandbag them, or you slow roll them. You can ruin your reputation from poor investor relations. Would you agree? Mm-hmm. Have you seen that at all in some of your not from you guys, but from colleagues that have maybe not been on top of communication and blew up in their face?
Me. Yeah, early on, trust me. Like we learned to over communicate because there was a time when we under communicated, and it made life very difficult for us. And we just found that, just ripping the Band-Aid off and showing them the truth and showing them what's going on behind the scenes. And, it just helps get you over the hump. Because again, like I said, a lot of our investors, they're business people too. They've gone through things and stuff has happened, and they can sympathize with you and they can empathize with you. And as a matter of fact, they can help you through those times. So it's just been something that, that over communication. I like that. Walk out good news and run out, sprint out bad news. That's a great philosophy.
Good mantra. Yeah, yes, for sure. Yeah, and so investor communication is paramount in any market, but in this market, it's a little bit different. So we have what many people think higher for longer in the rate department. So what specific changes in your acquisition underwriting, maybe your finance strategy or value creation playbook? What are some of the changes or things that are working well in this new environment?
Well, for us, like where we're really focusing on right now is when COVID happened and the government was ramping up the money making machine, and we saw the dilution that was happening. We knew that inflation was coming. We mitigated a lot of our future interest rates. We forward fixed mortgage, tried to put that any of the things that we couldn't control, we got them under control and early and worked on that. Right now, what we're seeing is we're still seeing the lag of where inflation affected things like insurance and affected maintenance and labor and things that went on. But our rents have not yet caught up to that. Remember the slinky we used to have that used to bend down the stairs? How the slinky, yeah. Well, inflation hits and it hits all your expenses all at once. But for example, in the multi-res side, we're only turning over 20% of the units each year on average. And out of those 20% of units, we're not capturing them all because it's some of the same units that are turning over each year. So we haven't, so we're still playing catch up on mark to market. Okay, because rents are inflationary driven, just like anything else. It's catching up to the inflation mark. So we have mark-to-market gains on our apartment fund. Same with our industrial and our retail funds. If we had a lease that was signed in a 10-year lease that was signed in 2017, it has not come due yet until 2027. And when it does, we will get that mark-to-market gap. And rents drive distributions for our investors, but then the gearing on that is the multiples of earnings for value. So they're going to gain on the rent and on the distribution side, and then right along with that, they're going to gain on the value creation of the new value of that lease. So we're seeing that come on right now as we sign new leases, and extensions and things like that. We're capturing that mark to market, but it has been a lagging factor. We have to communicate that well. And what does that mean? It means if you have a $29 unit apartment value, if we were to go to market tomorrow, it's a $49 unit on the apartment side, but we haven't been able to capture it because we have tenants who are staying longer and who aren't wanting to move, because when they move out of their rent, their property in Owen Sound at $1,000 a month, and the new rent, with some refurbishment and stuff like that, is $1,800 a month, not just a year, it's a month. That value is a $200,000, $250,000 value on one unit. So those are things that we are unlocking, and we're continuing to see go forward on all of our funds with that. The clean energy fund's a little different because where we get our mark to market is with older technology, going and replacing new inverters, going and placing more intensified direct current DC panels with higher production panels. We're able to get better curve on how we produce our power. That's how we capture mark to market on our clean energy fund, by driving efficiencies, new technologies all the time on that front. So it's exciting times, and it's all about squeezing the lemon. It's all about providing value for your tenants. Our tenants are value driven like anybody else. You do a great job, you run a great property, and you're in a great location, they're willing to pay for it. In fact, they would rather have that than live in some dingy old apartment building. So these are things that we like to bring value, and it translates into higher distributions for our investors and higher value on the unit price. And it makes for happy tenants too.
Yeah, you bring up a good point. I never even thought of that, of what happens when your tenants don't move. Well, you're a great landlord, so you're a victim of your own success, as they're saying, I actually like it here, I want to stay. But then on the flip side is when they move out, now you can kind of mark to market the rents and get it to more of a market price. Interesting. Yes. So if people aren't moving out, that could be a bit of a challenge, not just for you, but anyone that's has a whole portfolio of multifamily. Yeah.
But communicate it. Calculate it. We put it to our fund managers. What is your mark to market? And then if we were to gather that, when you turn over that unit, yes, you got to put a new kitchenette in there. You got to put a new, redo the bathroom or something like that. So you got to spend a little bit of capital, but you're getting this huge upside for a new unit somebody is not only able to pay more, but willing to pay more because it's a newer unit, and we can capture that. But yeah, we have so many demographics in so many of our different communities that we're in to look at. Some are university towns, some are blue collar, some are white collar, some are seniors towns, some are, tourist towns. Like all of those different communities have different tenant profiles in our buildings, even within the towns. So seniors buildings, you kind of get less turnover, but when you get turnover, it's big jumps because rents have been, tied to rent controls. But when that unit turns over, we can get a big jump. Other units that are turning more often, let's say in a blue collar building or a white collar building, when people's jobs change and they move around, we're closer to our market value on those buildings. Certainly with our retail and industrial, it's basically tied to who the tenant is and how long the lease was. We're contractually bound to that. But when it turns over, we're able to go to market on that because, what are their options at that time? And that's just, that's how we get value out for our investors.
Brilliant, man. And speaking of value, we got to select the right market too. And this is an area I think your thesis really starts to shine. So what are some of your non-negotiable filters for entering or exiting a geography, especially in those secondary markets that you guys love? And how do you avoid overpaying in some of the crowded trades? Yeah,
well, there's not a ton of competition. The snack bracket size that we're at in our buildings is beyond what a lot of us as individuals could afford. So that's what's made us successful. We're bringing institutional quality assets to the everyday investor, but we just pool our money together, and we're able to negotiate and get those institutional quality investments in those communities. So we go in. People have asked us all the time, like, who are your competitors? And we don't have competitors in this business. We have peers that some do the same as us, or some venture into some of our markets where we overlap on. But when assets come available, first we try to dig them out ourselves, turn over rocks, talk to the owners. There's many landlords and owners that I've dated for many years, going to the local town and the local Chinese food restaurant every year and ask them when they're going to sell, and finally they do. And that's where we're playing the long game here. But when it comes down to price, we have a yield and we have a hurdle rate that we have to make for our investors. We have a return rate now. We don't want to buy anything that's going to be a drag on that. We want to buy something that is going to be value add on a distribution and on a value play, at least in the short to medium term, and then long term, obviously. We look at the opportunity, we look at the community, we look at what is it growing, is it shrinking, is it what are the influences, what are the major employers, what are it's pretty easy, if we go in a community, Walmart's already there, well, they've already done the homework, they know what that community brings. We just have to be a copycat on that regard. So there's things that we do where we look at, and then we just have to be disciplined when you're buying. You can't chase. That's the beautiful thing about being diversified across so many areas that are in favor, one in one province or one community maybe aren't in another. So we can always be shifting coast to coast to find out where, and be growing in different parts from time to time.
Brilliant. So with that, we talked about market selection and finding those. Also alpha. A lot of investors love alpha. So where does Skyline generate the most repeatable operational alpha today? Is it asset management, construction, leasing, and how are you guys measuring that?
Well, certainly asset management. It's a common saying that you make your money on the buy. So you got to buy right. And as soon as you buy right, and then anytime anything with Skyline has that we have and has deemed wash, rinse, repeat, we internalize that. So we are vertically integrated from everything from our acquisition team. So asset managers go out, we do our own buying, we do our own financing, we do our own property management, we do everything from top to bottom on the company. We have our own legal team that does the closings, all of that stuff. So we create efficiency right out of the get-go. We don't have all this very high exorbitant capital cost on the acquisition. So buying right is important, and then just it's a grinding game that starts at the first of the month. And it's got your processes through to get to the 30th of the month to get to start all over again and do it again and again and again. So having discipline and staying with that and always updating yourself on the market, that's where we create our alpha. I think in being vertically integrated on running our own assets and just squeezing and pinching and pushing on every aspect of the business. It's tough. And I wouldn't say that Skyline's an easy place to work for, but it's a place that it's gratifying because we like to have great culture and we like to have that, but the efficiency drives us. So we just have efficient-minded and like-minded people working there, and we all get along just fine that way.
I love it. Yeah, there's a personality type. It's super rare. It's the one that I have. It's called the Myers-Briggs INTJ, and we are obsessed with efficiency. So having INTJs and personality, those are the ones that are like anything inefficient drives them absolutely mental. So it's a good personality type. They're rare, but they're great to have.
Yeah, that's awesome. Like, you think that high achievers, that you want to bring them on and hold them to a high bar. They want that. They thrive in that environment, and having people that they have to drag along is demotivating. And you have to be always driving and higher and higher and higher. And those people want to thrive in those environments, and they do thrive in those environments. So that's you just got to work on that, and that takes a lot of work with culture. It takes a lot of work with sometimes if you can't change people, sometimes you have to just change people. So if you want to continue to grow your business and get better, sometimes you got to turn over and move to a next level.
Brilliant. If you can't change people, then you got to change people. I love that. I'm gonna write that on my wall.
Well, I didn't come up with it, but it stuck with me because it's true. That was somebody in the company that told me that one, and I've loved it when I heard it. Yeah. Yeah,
it's absolutely brilliant, man. Now you mentioned
until
earlier,
I'm the guy that they have to change, I guess.
Then until it turns on you for sure. Yeah, I got
exactly.
Yeah. Oh, killer, man. So, one of the things that you mentioned earlier is that you have some clean energy stuff. So that was interesting when I found out, because, usually you think real estate and all the different flavors of that, and then you got clean energy in there. So I've been dying to ask you, man. So what's the strategic logic behind adding clean energy, and what are some of those underwriting assumptions that separate durable energy from a trend chasing allocation?
Yeah, I mean, our naming, like we could have just call it the energy fund, because really what happened is the apartment fund back in the microfit days, when Ontario was rolling out the microfit program, the 10 kilowatt systems, we made applications and we got them on our apartment buildings. And at first, a lot of our investors, they were like, it's government subsidized. It was, back then the government was doing that to kick off an industry and start an industry. And I have to say, the government got that right. I think they created an industry in Canada and got it to tip and happen. And we were early adopters of that because we were experiencing that ourselves on the farms we live at and the applications we were filling out personally, again, test driving this before we rolled it out. But a lot of our investors, again, like I said, were kind of weird until I told them how much revenue we generated from it. Then all of a sudden they liked clean energy. So it was not bad. It was the light bulb went off, and it was at that point that, again, microfit turned into fit, which was much more larger scale. The government wanted, the IESO wanted larger scale systems to be able to actually stabilize the grid and help with that. Well, now all of a sudden, these are size projects that you couldn't, the everyday person just couldn't get, the capital for and get it done and actually to maintain it and run it and keep it efficient. So it fit our model. And so we launched that in 2018 after experiencing it on our own buildings and, the pros and cons and pitfalls of keeping inverters up and running and keeping systems optimized. We brought in our clean energy expert, Rob Stein, to run that fund. He built a solar barn for me on my farm. So I met him back in 2010. And when the time was right, we launched that fund in 2018, and we've been growing ever since. And, it's funny, it's ironic you call it clean energy, because if you go into our Lethbridge biogas facility or our biogas facility in Elmira, Ontario, you bring a shirt that you maybe just want to throw away after, because it's the smell of money.
It's pungent,
It's pungent, but you know what? It takes waste from municipalities, puts it in it's a biochemist's dream of getting this together, and it creates gas that you can either turn a turbine and put energy back on, or you can scrub it. And through partners with major gas suppliers across the country, we've got contracts with those to put it back into the grid and supply heat and gas for these towns. So that's another aspect. And the Clean Energy Fund is always going to be evolving. The next thing now is, our antiquated pole and wire system across the country. It's going to take a lot of capital to upgrade that, or you can put these systems inside the bottleneck and where the power is being consumed. And so the battery system, the BEST program that's being rolled out now, is allowing for battery systems to be put inside that bottleneck, buy cheap power, put it on the batteries, and discharge it in the day when power is expensive and when it's being needed at the most. So this is the next phase of our business that we're going to be getting into, and we're going to continue to evolve with the time. So it's pretty interesting. And I tell our investors, and they quickly learn, it's not clean energy at a cost. It's not clean energy at a subsidized rate. Like, it's really come around that it's very self-sustaining, and it's very economically feasible to do at market rates without government assistance anymore. Like, again, I don't compliment the government very much, but in this case, I think they got this right.
Yeah, I think so too. Big fan of all kinds of energy, and this is a big issue. Just on a slight tangent here, but I did a whole thing on data centers, and the reason why they're not getting built at scale is not because we don't need them. We need them badly. We, as in North America, the reason why they're not getting built is because there's not enough power. Right. So having enough energy in the grid or wherever you find it is the bottleneck that you talked about, is to say we can put these in bottlenecks for whatever needs them. And now we can start fundamentally scaling up our infrastructure the way we need. If power is an issue, we don't need the sticks and wires. We can start maybe go solar, hydrogen. There's many flavors. But scaling that up, I think, is key. And I think it's wise to invest in all types of energy. So
we're just scratching the surface on them. The electric car, the immigration and the pressures on systems, and like you just said, data centers. Yeah, like these things are going to become ubiquitous in how we operate our daily lives. And if it doesn't work, people are going to lose their minds. So we're going to have to find a way to be able to deliver that energy, to run those data centers, to be able to power those electric cars and meet the demands of the growing population. So I think it's interesting times, and we're on the forefront of that. We're watching that, and we're participating in that wherever we can.
This is another issue, is scaling funds, and you growing it to the 10 billion AUM. There's some scale involved, no doubt, growing pains at certain junctions. So as headcount and AUM scale, alignment can get a lot harder. So I'd love to get your opinion on this. So what frameworks keep decision velocity high without turning the organization into total chaos?
Yeah, it is a fine line, and it's a tough thing to do. For the longest time, I think as younger guys running the company, on our boards asking us about our succession planning and all that kind of stuff. So we were like, we don't need to worry about it. I'm going to live forever. Well, that was 20 years ago. And, that reality is getting closer to home than you think. And so you want to, so we wanted to set up ourselves for the next generation. We celebrated our 25th anniversary 2 years ago. And we made a promise to our investors. We made a promise to our stakeholders and to our employers that we were going to, set this company up for the next 25 years and 50 and 75 years down the road. And so, we've now added depth to the company. Again, you don't want too many layers because you get inefficient, and now everybody's pointing the finger and nobody's doing the lifting. So we want to make sure that we have that in place. We have good systems and good teams that we've as we've gone a little bit deeper, as we continue to go wider. That's an important part in the evolution of the company as we go forward. But we're still driven by the same principles of efficiency and value add. And so those are things that we're always keeping an eye on. And it's hard because change is hard for people, and it's even hard to evoke change as well from myself to get that message across. You like to think you're a decent communicator, but sometimes it just doesn't. Sometimes in the name of speed or in the name of the way you communicate, it just doesn't get across. You got to let other people take time to digest it. You got to politicize in the company how things get done and all that stuff. So those are things when we were knocking out basements in Cole Road semis in the 90s that we didn't have to worry about. And it's the part of the business that we're still ever learning as we grow. Yeah, but it's good. And again, a great large investor base that have gone through these things. Some of our really large and successful investors are really great to talk to and ask how they did it. How did they get through it? So I feel fortunate. I just have so many weird places to turn to get help and to get advice from to go on that. There's a lot of advice you take and you can use it. There's a lot of advice that just goes in one ear and out the other. But you glean the things that work and kind of, just put aside the things that you don't think will work. So yeah, it's all part of evolving and growing.
Yeah. And a big part of evolving and growing is appreciating risk, also making appropriate, well-informed decisions. We can be wrong, obviously, but it's really doing everything in our power to manage risk. And this is something that we've talked a lot about on the show, is pitching retail versus pitching institutions. Very different. As I don't have to tell you this. When you pitch, this is just pure philosophy, but when you're either you as in, I would say, like institutional level allocator, but also someone that wants to pitch someone like you, or maybe CPP or whoever it is, you have to see them a little bit different because they operate a little bit different. And what I believe, and please keep me honest, is as you approach the institutional level, so you've been wonderfully successful, now you start thinking about downside. You're more of a risk manager than an asset manager. It's a subtle nuance, and I'm not trying to be cute, but it's a subtle shift in the culture and the operations of your fund, is to say, yeah, asset managers got us off the ground, but it's risk managers that are get us to the moon and to beyond. So when you face a high stakes decision with incomplete information, all right, so I'm teeing you up for a risky decision. What are some of your decision rules? Like what must be true, what can be uncertain, and what's an automatic no? So walk me through a little bit of that risk management institutional brain of yours.
Well, I mean, we have pretty good systems. I remember when I was doing the buying for the company back in the early days, it was like I literally, honestly, did a deal on a napkin. Like it was really with a vendor. We sat at a diner and we made a deal. We talked about it and we did it on a napkin. I took it to the lawyer and like his jaw hit the floor. Like I said, here it is. And you got to make this work. And he couldn't believe it. But so now we have better systems, tighter controls, better due diligence. A lot of things around that we do. And there are go and no-go factors, or go and no-go signals in a property that we have to adhere to. And if we haven't done out the due diligence that we are at, and when it comes time to do this deal, the answer is no. If we don't have it, if you want a fast answer on something without the opportunity to do it, the answer is no. If we're not sure what the market's doing, or if we're not sure that we can raise the capital for it, that our investors are going to be on side of something like this, the answer is no. So we have to be very disciplined on that. And I remember early on, like, having the anxiety, like the deal that you have on the go in those early days felt like it was the last deal that existed in the world, right? And you did everything to try to fit it and make it work and all that stuff. And it turns out that some of the best deals we made were the deals we didn't even do at all, because it could have got us into trouble. We would have spent years, if not decades, underperforming. And that then goes to your reputation. It goes to your whole operations team. It goes to your morale, your culture. And now you've got this laggard hanging over you. We've learned that really the hard way. You learn more from your mistakes than you do from your successes, clearly. And we are students of that. And we've learned tuition costs money, and we've paid lots of tuition in our days learning these lessons. Yeah.
Pay the tuition and earn the intuition. So hopefully, so now you got the kind of the gut feel from the intuition that you earned from not listening to your gut. So absolutely brilliant, man. So we talked a lot about a lot of things. And I always believe that whether you agree or not, but I believe we spend our first half of our career building our resume, and the second half building our legacy. So what do you want Skyline's enduring legacy to be 20 years from now? And what are you guys doing now to build that legacy on purpose?
Well, we've really set a focus to our investors. We've spent the first 25 years really building out a robust asset management, fund management business that is, like I said, deeply vertically integrated. All of the wash, rinse, repeat aspects are built into the system so that we can manage those with 1, 3, 5 year strategies that we're always putting in front of and always updating as the market conditions fluctuate and change. We have to make re-aim the gun over those times. The focus now is on our investors, and for us, we're not in this business to build it up and sell it. Because then what do you do with the money? You want to go put it back into assets, inflation-proof assets. So we are in the same boat as our investors, where we really want to set up a multi-generational legacy. And that comes from, having long-standing built trust, and through quantifiable performance, and through altruistic characteristics and things like that we brought to the business that our investors believe in and buy into and are with us for. So building that multi-generational thing, that you hear it's an often overused slogan, but Skyline's going to be around for a long, long time, as we focus on helping our investors transfer that wealth. They sit at the dining room table with their kids and then their grandkids eventually. And we like to hope and think that Skyline has come up from time to time has been a good, safe investment for them. And that's the next generation that we want to capture as these assets get passed. The investment in these assets gets passed along so that we can continue to carry on our legacy going forward. So we are really setting up for generations to come, because we're setting it up that way for ourselves as well.
Okay. So before we wrap everything up, this has been awesome, man. It's been so good to see you again. Is there anything else you'd like our fans around the world to know, ways to reach out to you if they want to learn more, anything at all? Well, I mean, because we do direct to investor, yes, we have our A series of shares direct to investor channel. We have our F series, which is through FundServe, where we go through the dealer network. We like to communicate that way through that. And then we have our institutional channels that we are setting up now, separately managed accounts for what the institutions are looking for. But for us, we really do enjoy the direct investors, the 6,000 households that we have. I believe we can take that to 60,000. We think that it's been a very successful part of a lot of people's portfolios, just through our own experience with our own friends and families and close investors. So, because we've gone that channel and done that from day one, we've become good advertisers of that. So we hope that people can find us on LinkedIn, on Facebook, and on all the social media channels. And we love to have a conversation. We're not high pressure sales. We just like to tell you what we do. And we hope that then it's something that you want to be. And usually if people are reaching out to us and talking to us, they have a pretty good
curiosity factor that we're happy to sit down and spend time explaining what we do. If I've gone on and rambled too long, it's because I just can't talk enough about Skyline, and I can't sort of compress all the things I want to say in a short period of time, because we got a lot going on and we really love what we do, and we love to share our story with our investors and grow together with them.
Yeah, as you should. I mean, you built to 10 billion AUM, so all of us are very fortunate to hear anything. So we're not worried about that. I could tell you're proud. I could tell you love your people. I could tell you love your investors. I could tell you were proud. And as a fellow Canadian, I'm proud of you too, buddy. So you built one heck of a business, brother. So just to summarize everything Jason and I spoke about, look to feeding starving markets in possibly secondary and tertiary markets as a way to create alpha. The other one is seek high performers and then get out of the way. So getting the high performer is one, keeping them is another. So, and then the third one is, while deals are important, so is how you finance and structure them. So ensure you can make those numbers work, even if you're in a high rate environment or whatever that might be, or you go find other complementary areas. You do these things and you too will be well on your way in your pursuit of making billions.